Okay, I'm getting started a little bit later than usual. Glad to see you there, Tyler. We're going to stream on down here, and today is the 13th of November. This is module 12, and we've got some things that we're going to be doing. I'm going to go ahead and close the door here, and I think we'll probably have some people who will look in later. Glad to have you here. Now, just want to talk about this because we're talking module 12, which is 11, 13, 15, and 11, 17, 17. So today I want to talk, we want to look at Hammond's Port 2, and I've got the key for that, and I'll pop that up there for a moment. Then we're going to talk some about the tree plan and what that's all about, and there's a case over there, the PDC project, that's going to be due on the 17th, which would be Friday. Then you've got 3 exams due. So again, I want to take a look just for a moment, and we'll talk a little bit about Hammond's Port 2, and then the PDC project, which is going to be, that one will be over, let me see where I've got that jewel at. Hammond's Port. That's going to be the, I'll find my pages here for just a minute because I had them marked. That's going to be over in, and let me find the, yeah, here we are. PDC's over in chapter 13. And it's going to walk us through the, well, it's almost virtually all of 13. Before we get into that, though, now I want to mention I also provided a PowerPoint for everybody, and so that they can see how we use a tree plan and tree plan guide. We won't get through all of this today. I'll also, now don't forget, Wednesday I'm going to do a pre-record, okay? More medical trips. I'm becoming like the Red Cross. But we will talk about the tree plan. It's pretty much what we'll look at this week, and then next week we'll look at the AHP in that case, and bounded rationality and satisfying. Now, it's up to you to take a look at the PowerPoint. Let me recommend that when you do so, that you download the PowerPoint, then look at it, because it's just very difficult to get the thing open. This is a tree plan guide, and we'll take a look at that in just a moment. But what I want to do is to go ahead and show you the key, okay, for Hammond's Port 2, and this, of course, is where we have 2 service stations, not just one. This is the case with the ATMs, and so here's the key for Hammond's Port 2. Okay, and I'm going to download it here for just a moment so we can go ahead and mess with it a little bit. And what we did was we used goal seek, okay, and here it is. We're going to, and you'll want to say this, well, you should have uploaded already, but we're going to use goal seek to obtain the number weighting to 70 by changing the standard deviation for service times. And so we wanted to go ahead and just use that tool to set it there, and we want the number of weighting to 70. So let's go up here for just a minute. We'll click on data, and we're going to do a what if analysis. We'll use a goal seek. We'll just play with this for a second, and I want to set the number of people weighting to 70. So I'm going to pop down here, and then to 70, that'll be the value. And we're going to do it by changing the standard deviation for service times. Now you say, now why did you change the standard deviation for service times? Why wouldn't you change the mean? The reason is this: standard deviation is a picture of variability, okay? And it mirrors the variability that we introduce when we randomize, we do those 1,005 or 1,000 random trials. So we want to match those up, okay? So we're looking at a range, okay, with the standard deviation just as we're looking with a range of the number of people waiting, just as we're looking at a range with the simulation when we put that random in there. So we'll click OK and let's see what we get. And you can see the numbers will be working there, okay? And they tell us we hit a target value of 70, okay, when the standard deviation is 0.513. Let's just call it 0.5 among friends, okay? So the service time is about a half off of a mean of 2. So the service time, so if we want to come back later and evaluate this, if we assume that the arrival times, okay, if we assume that the service times are distributed on a like a Gaussian distribution, then we're going to say, okay, it's going to range somewhere between 2.5 and 1.5, about 70% of the time, okay? And that's not too bad, you know, in terms of having, you know, in terms of having a distribution, because it's not that large of a gap between 2.5 and 1.5. I mean, we just don't, that's a fairly fine cut. Now, I also had provided a key, and you can take a look at that with a screenshot. And I'm going to cancel this for just a moment, and we'll go back and we saw, okay? And I want again to remind us, as we look here, okay, we're going to look at enter arrival time. That's one person comes in, the next person comes in, the next person comes in, and that's why we're concerned about the number waiting down there, okay? And we had set it to 70. We could say what would it look like if it's 60, 50, whatever. And it also gives us a way to set a goal, and that's why it's called goal seek, for our service time, how much tolerance we can accept, okay? And so we could accept about 2.5 service time or a 1.5, somewhere in that range. Now, you'll see we're taking B4, which is the smallest value, plus a random value times B5, which is the largest value, minus the smallest. So we're randomizing the difference between the smallest and between the largest and the smallest, and we're adding it to the smallest value. Okay, so what we're really doing here is kind of mimicking or creating a z-score for all intents and purposes. So that's pretty much with Hammond's Port Bank. Of Hammond's Port 2 is, in this case, we're looking at 2, okay? We're looking at 2 ATMs versus just 1 ATM, and things just get more and more complicated the more service stations that you add. If those are all parallel, meaning people can come into any one of 6 or 7 service stations at one time, or like when you go to the store, you can walk in and here's this aisle. Here's this person's checking out groceries, or you can go through this the ATM piece there and scan your stuff and walk out. That becomes a little more complicated, and is a different critter than I have 7 steps in a process where I make something. Okay, that's a linear kind of process, and that introduces a whole different set of issues and problems that we have to deal with. So that's Hammond's Port number 2, and a pretty good case for us to take a look at. I see I've had some more other folks come in. Glad to see you, Conley, and Nick as well. Glad to see you here. So I'm going to close that off. I've published that, okay? And I'm not going to save because you have the key already. So let's go back, and I'm going to throw that off for a sec. And let's go back here, and we're going to start to talk about PDC and that project. And again, we're down here in Module 12, okay? And don't forget, I'll remind you again, the 15th will be, which is Wednesday, will be a pre-recorded session, okay? So you'll have that session will be pre-recorded for you. But I have a PowerPoint for you which will summarize a lot of the material in Chapter 13 where they cover decision analysis and risk analysis. Now, I want to just take us through some of the issues. And this PDC is a firm, and they're trying to make a decision on whether they want to build an apartment complex and what size they want to build, i.e. how much money do they want to invest. And I'm going to turn the light on just a second. I'll be here. Now we're assuming outcomes with these with different outcomes with each decision we make. And again, as I've said over and over and over throughout the course, we use management science to build a model that helps us understand the range of possible outcomes. Okay, and if you look at manufactured products, all right, it's the same principle. When let's say when soda is bottled, okay, and a cap is put on, there's a little thing on the cap that it twists off, and once you snap that it's a little guard. Once you snap that guard, the bottle's open. That makes it tamper-proof, okay. Plus, it helps keep, if it's a carbonated beverage, it keeps the carbonation in, etc. Well, you get a range of that, okay. And it's the same prospect with any kind of investment situation. We could be talking about a portfolio. Here we're talking about building apartment complexes, and over in chapter 13, and I'm going to walk us through it because I have a guide for you to look at as well as chapter 13 PowerPoint, and there's an example, okay? And I want you to take a look at that tree plan example. But if we go over and we start to walk, and I'm going to be a little more didactic today and Wednesday than I normally am, because I think this is just such an important chapter for you to really grasp and to get. We start to see what we call influence diagrams, and they mention this over in 603. And they show us in figure 13.1 an influence diagram. Now, this should ring fairly familiar with you, because anytime you've taken a class with me, you know that I always say that what we do can be summed up in an equation, or it can be summed up in terms of a matrix. The quality of decision we make, okay, is a function of our understanding or knowledge of the states of nature or conditions that are operative, and our understanding or knowledge of the alternatives or options we have to deal with those different conditions or alternatives. And then you'll remember I use a matrix, and I'd have a matrix where I'd have known states of nature or conditions, unknown states of nature or conditions, known alternatives or actions or courses of action we can follow, and unknown. And within that matrix, when it's known and known, that's easy money. When it's unknown and unknown, that's the part where the management science can really, really help us out. Now, when we have known problems and known solutions, okay, we can use management science to expand our understanding there. And as you recall, we move that line in that matrix just a little bit to the right, so we get a little bit more understanding of the outcomes that we can get, or the consequences or the payoffs of our decisions. So this chapter is not just about doing a technique or something like that. It's about a mindset, and I can't emphasize that to you enough. Okay, a mindset that says outcomes are not black and white. They're many, 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 many shades of gray. Now, I realize that you say, now, wait a minute. Are you saying there's no such thing as objective truth or objective reality in the world? Not at all, okay? What I'm saying is none of us is God, so we don't know what that is. And the only one who knows all objective truth and understands reality in the truth of reality is God. Okay, let me give you a real simple biblical example. Okay, and you're going, oh no, it's chapel time. I understand. Think there's a parable where Jesus is at the temple. This is a word story, and lady comes in, she's a widow. She's obviously not very well to do. And she puts a little bit of money in for her offering, okay, at temple. Then here comes a rich person. And it's interesting how our Lord would always give us a lot of comparisons of the person who's down and out and poor, or the outcast, versus the person who's well heeled or is well highly regarded in society. And so here comes this person who's very well off and puts in this big offering and makes a big deal about it. And Jesus says, according to God's standards, the widow is really the one who made an offering because she gave as much as she possibly could, not just a little bit. So when we talk about right and wrong, history, objective reality, only God knows. And our job as believers is to use whatever tools that he provides to us to understand that world so that we can do his work in the world. And his work includes not only we can preach the gospel by our lives as much as our words. Usually it's our words that do a whole lot more. So when we talk about, understanding that decisions are along a whole continuum of stuff that can be really, really bad or stuff that can be really, really good. That's why this chapter is so important, because it shows you that in a very concrete way. And it provides you a method of thinking, okay? I understand that when people take management courses, they tend to think, well, this is soft, fuzzy stuff. It's not really applicable. And then they hit management science with me, and they go, wait a minute, this isn't science. Yeah, management science is increasingly the mindset, or we talk about the kinds of mindsets you have to have as a decision maker, okay? Because remember, there's a difference in problem solving and decision making, okay? And remember, we talk about building models. Well, if you look there at the bottom of page 603, and when I do one of these casts, okay, whether you were if you're in the classroom this morning with me, or you're wherever you're at, you ought to have your textbook open. You're learning your craft. You're learning to understand this stuff. So, and if you're sitting there taking notes with your book open, even better for you, okay? Because it's going to reinforce some things. And if you take a look at the bottom page 603, you're going to see that influence diagram for the PDC project. And notice what we have, okay? We have demand. That is the level of demand that they anticipate there will be for these apartment complexes, okay? And then they have the size of the complex, okay? And in both those two variables, the complex size, that's controllable. That's why it's in a square box. I can control what size of complex I build. What's not really in my control is demand. Now let me say this. A marketer might say, no, wait a minute. If you marketed this well enough and you did as good a job as possible, even in bad economic conditions, you could build the biggest complex and sell everything. Theoretically, yes. But you and I are paid to be somewhat risk averse. The reason is because typically we're playing with other people's money, okay? So we don't have the right to take those gambles. Now, if the culture of the company is such that we take the big bet and go for it, fine. Okay, if it works out, fine. If not, you're in real trouble. You could also say, well, the position in our company is such that, well, even if the economy is weak, we're going to build a great big complex, and we're going to rent it below market level, so we fill it, okay, so that we have the market. And as people come and they leave, okay, the prices will go up. And so we're going to buy some market share for the future. That's a perfectly acceptable, a very perfectly acceptable way to do it. But that's over there in 6.3, okay?
So 0 is a chance node. Then you have the the profit or the consequence node, and of course the decision mode is the complex size. And notice we have 2 states of nature, strong or weak. We have 3 decision alternatives. We can go small, medium, or large, and the consequence is profit. Okay. From here on out, everything about the PDC project or a planning tree becomes an issue of attaching probabilities and outcomes to each of the different, to whatever decision we make. So we're back to basically a payoff matrix, okay? And that's really what we're going to be, looking at. Now, right now, if you're looking at figure 13.1, in its raw form, it assumes equal probabilities for states of nature and for the complex size, because all probabilities have to add to 0. Okay, and so we're looking at those two, and this again is the influence diagram. All right, now the influence diagram implies something about you and me as a decision maker, and I think the authors do a great job, okay, in terms of explaining what that's all about. Well, if we go over to page 604, and I said at the start of this, I apologize, I'll be a little more didactic than usual, okay? If you take a look at table 13.1, you're going to see something that looks very familiar to you, and that is a payoff table. If you took you did your finance course, you learned about a payoff table. You probably learned about a payoff table in statistics, okay, where we take states of nature, okay, and we take decision alternatives and we attach a value or outcome to them. Now, at the top of page 604, table 13.1 is still a raw table with raw values and raw probabilities, because what it says is, without saying anything different, we're assuming that the demand state of nature 1, S1, and state of nature 2, S2, are equal, 50-50. And that's probably not going to be true. It's probably along a continuum of those, okay? And then the same thing for the decision alternatives. We have 3 decision alternatives, D1, 2, and 3, and in that raw table, we're assuming that they have equal probability. Now, this is important for you because let me tell you what, when you go out to work, especially if you go to work for a big company and one that's really, really good, or maybe you wind up doing consulting, what you're going to find is most of the time people stop right there, not truly understanding the implications of what they're saying, that these outcomes are all equally probable. And the outcome or the payoff is the interaction of the decision alternative and the demand. Okay? Now, if you took BISS 1123 with me way long ago, you'll remember when we had a case where we used a data table and we did a capital budgeting exercise and we had different levels of interest, okay, or capital hurdle rates versus different annual, I think we did initial investments, and then I think different annual incomes that we got from that investment. And we built the data table, and we were able to see that range of things. In fact, I even had you go in and use conditional formatting so you could see how things changed, how the profitability index went down the higher the interest rate and the lower the annual income, and then just the opposite, and it displayed it very, very nicely. Okay, well, when we come down to page 13.2 at the bottom of 604, we see that thing flipped, okay? And we see a decision tree, and we see the payoffs in millions, and we have small, medium, and large, and we've just flipped that. That's all we've done. We just put that, what's up in that table, into a decision tree. So there's a process here, and we build through that process by working with we start with the payoff table, then we move to the decision tree, okay? And you can see how it's out there. Now, we can also, if we want to, add in some things like the regret we have, strong, regret for weak. So we can look at the regret. That is, gee, we built small, but actually the demand was high. So how much money did we leave on the table? Well, if we went small and we thought that the demand was going to be weak, okay, we thought we got 7, or we got close to 7, when the truth is, okay, we could have gotten 20. And so we've got that regret there, okay? And the regret there on the small would be 12, when we thought we'd have a strong demand but small. We'd put strong demand, but we build a small complex just to be safe. That would be probably a pessimistic type of out to say, okay, well, we're going to try and minimize our losses. We also minimize our potential gain, because remember, risk and reward, if you put that on the chart, okay, on the x-axis, okay, is going to be the reward, okay, and on the y-axis is going to be risk, and the higher the risk, the greater the reward, and vice versa. That's just pretty typical, okay? Now, on page 605 and through 606 and 607, all the way over to the top of page 608, the authors talk about decision-making without probabilities, okay? We don't have to try to attach probabilities to states of nature or to outcomes, okay? We can just have a strategy and try to follow that strategy. And so this is decision-making without probabilities. And I would also call it I would call it somewhat naive because outcomes are not going to be the same. Conditions will not be the same. It just doesn't work like that. But they walk you through that whole process of talking about the optimistic approach, okay? And we look at the best payoff that we can get. Then there's the conservative approach. It says we'll hope for the best, we'll plan for the worst, okay? And that's there at the bottom of page 605, and they show you a maximum payoff for each of those, of the decision alternatives, the maximum payoff, okay? And then they start to walk us in page 606 into the regret approach. Leaving money on the table. Oh, why didn't I buy Apple when it was 60 bucks a share? Oh, why didn't I buy Berkshire Hathaway why didn't I buy that stock when it was 150 a share? Now it's 15,000 a share. Why didn't I do this? Why didn't I do that? Okay, that's the regret approach, and we begin to talk about that. Did we leave money on the table? Okay, and so there at the bottom of page 606, they walk us through the mini-max regret approach. Okay, and it's neither optimistic nor purely conservative. Okay, and there, what we're after is, okay, our objective is exactly what it says. We want to minimize our maximum regret, okay? We want to minimize the maximum regret. And so what we would do here is we would probably go with the small complex, saying, okay, if I build the big one, I'm going to lose out big. If I build the small one, I'll come out okay. I might lose some opportunity, but I'll be okay. They're at the bottom of page 607. They walk you through the opportunity loss or regret table for that condominium project. Okay, and I'll show take what they're looking at. Okay, with the states of nature: strong demand, weak demand. decision alternatives, small, medium, large, complex. Now, if we build a small complex, okay, and there was strong demand, we have a regret level of 12. Why? Because we made 8 when we could have made 20 million. And on the medium complex, we're going to lose 6 million there because we could have made 20, but we only made 14. And then on the large complex, when we assume large demand, boom, right into, there's no regret. And then over on the weak demand, the same story. Okay? What we'll find if we do it correctly, if you look, you see the strong demand and the weak demand, the two of them will always add up to the same thing. And our weak demand, okay, is the sum of that is 18. The sum of the strong demand is 18. That's when we know we've done it correctly. And that lines up with the fact that we're assuming equal probabilities or some kind of probabilities. All right. So again, this is a mindset, but we can make decisions, okay, on this basis, and they can have strategic consequences. And we can say, okay, we're going to choose to do a mini-max regret approach. Okay. Now, who would do that? Let's talk about the kind of company that would be involved, who might say, okay, we're going to use the minimum, we're going to use the mini-max regret. In other words, we're going to minimize our maximum regret. Well, manufacturers do this, okay, because they have to build prototypes. When you make something today, not only do you have to make the product, you have to invent the way of making it, tools, production lines, facilities, supply chain. You don't just start making stuff. That all has to be orchestrated. So you can have a lot of regret. You can have a lot of regret if you miss an opportunity. Okay. Another would be, well, let's take a sports analogy. Saturday night. Here's an interesting one. Okay. TCU was playing OU, and I think TCU had the ball on the OU 39 or something like that. It's 4th and 3. Now OU's been going up and down the field. They've scored twice or 3 times. I think it's 21-0 at that point, or something. I think this is near the half. And TCU, rather than going for it on 4th and 3, kicks a punt. Well, OU takes the ball and goes 87 yards and adds another score in the half. That was a minimax regret approach, although the coach didn't know it. Okay, what he was hoping was to try to minimize the score, okay, or to minimize his maximum regret, which is they score another touchdown before half. Unfortunately, while he made a rational decision, it was also irrational. I bet if you go out and look for statistics on that team, or if you look for statistics in college football, you'll find that the probability of a team making it on 4th down is pretty high, a lot higher than people think. And as well as that team runs the football, and they do, I would have said, run it, okay? But they chose to punt, thinking that if they added in additional yards, that would lower the probability of that regret. It didn't, okay? It just added to their problems. If I'd have been him, I'd have gone for it on 4th and 3. Who knows? You make it, you go down, you score, and you change the whole complexion of the game, okay? And so that's a good example of that. Another would be a pharmaceutical company. It costs a lot of money to develop pharmaceutical products, enormous amounts of money. That's why they're so expensive. And what drug manufacturing pharma companies try to do is minimize their regret. They don't want to spend $1 billion or half a billion dollars on something that can't get approved by the FDA, and thus they can't sell and recapture their investment. Okay, so those are the kinds of situations in which that approach is utilized. Now, the text does a really good job, okay, of walking you through that, of those alternative approaches, okay. When you're making decisions without probabilities, here's the problem. Every decision has a probability attached to it, okay? It may be infinitesimally small, but it's a probability. It's like you'll hear the airlines, after there's been a major airline disaster, 250 people get killed or something like that. The airline industry will count and say, well, we're still safer than driving. Well, yes, they are, okay? If there's a catastrophic failure in your car, like the brakes go out or something like that, you know, the odds of you dying are pretty low, okay? But there's a catastrophic failure at 30,000 feet. You know, I hope you know the Lord, because you're getting ready to go see him. And that's one of those things that you have to look at and understand that all decisions have a probability attached to them. You just don't know. Now, the worst of it, and one of the reasons that people have tried to use the Minimax approach, minimizing my maximum regret, is a thing called the law of unintended consequences. Okay? The law of unintended consequences. I'll give you an example. One of the best examples I can think of is the housing bubble. The housing bubble got started back in the early 90s when then President Clinton decided that the way for people in the middle class, lower middle class, and lower class, and even in the upper class to build wealth was the old-fashioned way. You do it through your home. For most Americans, 99.9% of us, our wealth is based in our home. That's why you hear about reverse mortgages. That's why, you know, people want to pay their home off, etc., because it represents value. It represents wealth. Okay. Now, that's great. And so the president began to work with the Federal Reserve and to work with FHA, people like that. Okay. Freddie Mac, there's Freddie Mac, there was all those different banks, and work with the Federal Reserve and to work with the private sector to begin to get interest rates down, okay, and also to provide some pathways for home ownership for people who'd never owned a home before. And so this began under President Clinton, and we started to see it build, okay? Now, President Bush came in, he tweaked a little bit, but it continued on, and then we had the housing bubble. And why did we have the housing bubble? Because of unintended consequences. Because we had people like Countrywide Mortgage writing mortgages for people who could never pay back the loan, or writing mortgages that were so funky that, you know, you could never refi. Now, what they'd do is they'd sell it. They'd get someone to take a house, okay, that they certainly couldn't afford. And what they would say is, and there was usually the real estate agent and the mortgage lenders involved, etc. They would say, well, you know, yeah, you're a little bit underwater, meaning you owe more on the house than it's worth. But in 3 years, in our contract, you'll refi. And when you refi, this house will be worth $50,000 more. So you'll refi at a lower rate, and you'll rock on. The 5 years later came, and then and houses weren't selling. We had a series of economic conditions that occurred, and the bubble burst, and people were sitting there upside down is the term. There are many people who buy vehicles. They're upside down. In other words, they owe more on the car than it's worth. Okay? It's the same thing with the housing bubble. A lot of that. And it was an unintended consequence. One of the crazy things they did was to go out and say, okay, here's what we're going to do. We're going to
if you have $100,000 in a checking account, we're going to say you're good credit risk. And write a note, write a loan. They were called non-conforming mortgages. Now, it is easy for you and I when we see the news accounts or we read the sad stories of people who say, "Oh, I lost everything," to say, "Well, you idiot, why didn't you know better?" Well, you know, that's easy to say, okay? And by the same token, not as easy to put in practice. But that thing, the law of unintended consequences, is an extremely important thing to think about. Okay. Now, over on page 608, the authors walk us into the issue of making decisions with probabilities. Now, when we did the Foreman book, okay, the Data Smart, we learned about naive Bayes, okay, and we learned about the naive assumption that events are independent. When events are independent, they're computed, the probability is computed differently than when we assume that events are dependent. In other words, A causes B causes C. That's different. Then if we say the probability of A and then the probability of B, those are different critters. And they call it naive Bayes because we assume the events are independent. Okay? Now, here we look at decision making with probabilities, and they give us in the middle of page 608, okay, the number of states of nature, and P is the probability of the state of nature out to Sj, or out to infinity, okay? And we assume, okay, that the probability for all states of nature is greater than or equal to 0, okay? Now, actually, they should be 0. And I disagree with the authors on this point, that you can have a probability greater than 0 for all states of nature. I just don't believe it. Okay, I think they all have to add a 0, and I'm a purist in that, and I disagree with the text in that sense. Then they show us the expected value, and the expected value, they give us a formula, and it's kind of these formulas are so the authors can show you, yeah, we know our stuff. Then they show you a practical example, and you'll see that at the top of page 609. Okay, top of page 609, you're going to see we compute the expected value for each of the 3 decision alternatives as follows. Now let's look at this. The EV is, of course, expected value. All right, and you'll take a look at an expected value for decision 1 is we assume that the state of nature, okay, 1 is going to be 0.8. And that the state of nature for the state of nature 2, the probability is 0.2. That's where they get that 0.8 times 8 plus 0.2 times 7 gives you the 7.8. Okay. Now, I would say that if you were doing this type of analysis, okay, in terms of a grade as a company, I'm going to say you're probably a B student. If you're starting to say, no, wait a minute, we better start to calibrate this a little finer, okay, I'd say your company's an A student, right? And people have to make these kinds of decisions all the day. A good example of what's at the top of page 609 is, okay, if I drill out in this part of the North Sea, will I hit oil or gas? Now, I've done geological surveys. We've done some preliminary drilling, but to drag or build a oil derrick, i.e., an offshore oil platform into the middle of a place like the North Atlantic, which is a very stormy place, very volatile, it costs a lot of money. And if you're the one making the decision for the shareholders, you want to make sure you're as close as you can get on that one. Because once you're out there, you're out there. Now, if you come down to the bottom of page 609, okay, you're going to see the PDC decision tree with state of nature branch probabilities. Okay, and you can see the small, medium, and large. You said, so what you're saying, Dr. Harmon, is maybe you might want to have 6 states of nature. Yeah, okay. And if my alternatives are limited, let's say that my alternatives in terms of the size of the complex are small, medium, large, and are dictated to by how much money I can spend, i.e. how much money would a bank loan me, then okay, then I'm going to be splitting hairs on those probabilities as much as I possibly can so I can see the potential range of outcomes. Okay, so I'm not surprised. So there at the bottom of 609, they walk you through that decision tree, okay? And you can see that's where they end up with the, all they do in that decision tree is they just take that table that's at the top of page 609, or those 3 lines, and just divide them out and show you. Okay, now the tree, okay, is designed to walk us through the process, especially if it's not linear. And when we're involved in decision making is never, ever linear. It's, as I said, it's not black and white, it's nonlinear. You can make decisions and things can be just not quite like you think. That's why you spent some time in statistics, so you can learn about measures of statistics. Hopefully you got from statistics measures of central tendency, okay? And on the other hand, you got measures, okay, of dispersion. How much does stuff cluster together? Oh, this sounds like that Foreman case that we did, where we did the cluster analysis. Yeah. How much do things tend to separate? Oh, this sounds a lot like the outliers case that we did. You betcha. Okay? That's why I gave you those 3 cases, so you can understand that dynamic. We're always looking for, how do things tend to stick, or what are those outliers? Because sometimes the outliers can start to tell me some things that I may not have anticipated. Okay? Now, over on page 610, okay, this is what you'll see in the PDC file. So I'm going to go over here to the file for just a second, okay? And go to the files section, and then we'll look for the MSC web. The web files, and we're going to open this and we'll download it. And we're going to come over to chapter 13, and we'll open up the Excel files, and we'll see the PDC tree. Okay? Now, the authors have said this is only for academic use. That's what it is for. And because they've got some nice art, they've done a little bit they've inserted some figures and things that reproduce that decision tree. Now, the beauty of this is I can plug in different probabilities or different outcomes, okay, to see how things will end up. But we start over here, and here we are, we're at, and let's look at this. This is the maximum, okay? This would be the maximum value that we think we can get, which is 7.8, 12.2, or 14.2. So what's the maximum outcome I can get? Okay? And I get those. On the other hand, I could say, and I'm going to take this, I'm going to copy this formula, okay? I'm going to come over here and throw it on a notepad. And this time I'm going to use the minimum function. And I'm going to put it down and I'm going to take this function and paste it into another cell. Now let's see what we get. And we get 7.8. All right. If we put in the median, we should get 7.8 again. Okay? Or I could do this. I could say, what's the average? And for those E16, E26, and E6, there we go, 8.55. Now, the numbers help us hang our hat on something, okay? And the way I kind of envision this is when I work with this kind of a situation, I imagine I've got points, on a number line, or I have some that are way out to the right, some that are way to the right, left, and some are just all clustered in the middle. You could put it in an axis if you want to, an XY axis, a full Cartesian axis, and see where they all land. Okay, so that's really what we are indeed looking at there. Now, it's 11:48, and here's what I'm going to do. Okay, for Wednesday. Okay, for Wednesday. What I'll do is this. I'll go further on into the PDC project. We'll talk about it some more. We'll have some more of the files. We'll work with them. Okay. And then we'll move into risk analysis and sensitivity analysis, how that works. Okay. And sensitivity analysis is a way for us to determine which variable, okay, seems to be the one that really can hurt me or help me. And that's an important piece there, that you really got to get that and kind of understand it, because not all variables that we feed in they don't have the same impact. They have different impacts. And that's when we start to say, okay, I've got this company. I'm looking at its income statement. All right. What piece of this really changes everything? Is it sales? Is it inventory control? What in the world is it? Okay. And one of my favorite things to do is to show people the top end of an income statement. Okay. Net sales less cost of goods sold. Okay. And I'm going to do that for just a second here. Okay. And I'm going to find Excel. I'll show you, so you can understand the sensitivity analysis and what it's all about. And this will just kind of help you a little bit. That's sales. And let's say the net sales, these are going to be millions or 100 million. Okay. And then I have the cost of goods sold. Okay. And that's 40 million. Okay. And I have SG&A, sales and general administrative costs. Okay. I'll just call it SG&A. And that's going to be, let's call it 20 million. Okay. And then, of course, then a gross profit. This will be a zero. Probably a negative number. This will be a negative number. Hang on here a minute. Okay, and then we'll make this. Oh, we can just put this in capsules in parentheses if we want. Machine will understand. Okay, and we'll look at the sum. Here's the auto sum. Now, it's 60 million in expenses. 40 million was cost of goods sold. 20 million was sales, general, administrative costs, and I've got my gross profit of 40 million. Easy enough. Now, what if I wanted to increase the gross? Let's see which of these might be more sensitive. To get that 10% gross, okay, I need 4 million more, so that I'm at a gross of 44 million. Let's see what happens if I reduce cost of goods sold down to 36. Okay. Which of these is the easiest? Laying off people, scrimping on the lights, etc., sales, or is it managing my cost of goods sold? getting fewer things that I throw away, getting a better price for delivery of my goods and services, managing my inbound better. Well, right there I can see I have practically a 1-to-1 sensitivity between there's for every 1% change in COGS that goes down, I change the gross 1%. Okay? So, and that's probably the most controllable of all of these inputs. So that starts to give you a little bit of a taste of what we're talking about when we talk about sensitivity analysis. Well, we've gone on now. I think we started about 5 minutes early, so we've gone about 58 minutes. I think we've had our time. And where we'll start in, if you've been following along, which I pray you have, is we'll start at page 620. On Wednesday, I'll do a pre-recorded screencast where I start at page 620 and I go through the rest of the chapter. Okay? Thank you so much. Let me stop before. I've got 4 of us in here. Does anybody have any questions? I'm going to unmute everybody. Anybody have a question?
Nope, I'm good.
Okay. Tyler, any questions? Caleb, any questions? Okay. Okay. As always, if you have something, shoot me an email, and I'll have that pre-record there for you guys on Wednesday, and I'll finish off chapter 13 where we look at decision-making with probability, and we'll also look at sensitivity analysis. Thank you so much, and I'll stop the share and then end the recording.